On Talking Point today, our guest is Prateek Agrawal, MD and CEO of Motilal Oswal Asset Management Company. We talked to Prateek at a point of time when the AMC has hit a cumulative AUM of over 1 lakh crores. And we talked to him at a point of time wherein if we get the case for a chat up, you will see what really is the key thing and which is 2 or 3 factors. Because India's weight in EMs is almost within the knocking doors or knocking on the doors of hitting the highest ever for India, of course, but more than any other country, including China. Can it pull further FPI flows, and will that turn? Further legs for defense theme, do they exist after the last 2 days of some bit of revival there? And will renewables continue to be the key power play? That and more. He's the MD and CEO of Motilal Oswal Asset Management Company. Joins us right now on the show. Prateek, good having you. Thanks for taking the time out. I hope all is well.
All is good, getting better.
Getting better, I can understand that, Prateek, because for an AMC to reach a milestone number of 1 lakh crores is pretty strong. Prateek, tell us, one, this growth obviously has come on account of this inherent belief within the Indian retail investor that the story will continue. Do you believe the story will continue?
Yes, we believe the story will continue. I think more important, if we flesh it out, if we dive a bit deeper into this, trends continue. Trends continue for many years. So, for example, 2000 to 2008 was a period of capex-driven growth. Capex intensity of the economy went up. And 8 to 2021 was a period of consumption-driven growth. And again, from 2021 onwards, we are seeing increase in capex intensity in growth. So the point is, these trends last for several years. In the new trend, we are just in 3 years. If you test the trend for various events that happened over the past quarter or so, new government coming in, with the first budget and all of that, I think reason to believe that the trend of capex-driven growth continues deeper into the future.
Okay. Prateek, there were question marks around whether the new government in its avatar, wherein it's a coalition, NDA coalition government of sorts for the first time, will there be some checks and balances on the frenzied activity of capex that was there in the second term of the NDA? You don't find any concerns around that?
We don't find any concerns around that. If you look at the budgetary maths, very clearly for various reasons, maybe fertilizer subsidies are lower, etc. But subsidy as a part of budget is going down, and capex as a part of budget and hence GDP is strong. So we think the trends continue. Even after that, whatever we are seeing on the ground in terms of new ordering, etc., has retained momentum.
Well, some bit of this is vindicated by the fact that if you look at the EM pack year to date, India is arguably maybe the only one or only large market to have given the kind of returns that India has, and which is a telltale fact of the kind of buoyancy that has come in from the domestic investor. The point is, viewers, I just want to mark before I would love to know Prateek Agrawal's view on this, because it will be lovely to know. Look at that first for currency adjusted returns. India is 15%, China, South Korea, Brazil, all of them YTD have been negative. The other bit is, because of this, India yesterday eclipsed China in the EM IMI index as the top weighted emerging market. And as per the Morgan Stanley note, India is knocking on the doors of being the largest emerging market in the MSCI EM index, the weightage rather. And that is a big deal. That's in some sense a vindication of what India has done in the last 4 or 5 years since COVID. Prateek, I would reckon, you understand this better. I would reckon there is a good side or a good case and a bad case of something like this happening. India, for far too long in the recent 12 months, 18 months, for far too long has been ignored in terms of foreign flows, despite the weightage moving up. Now that we are on the cusp of a central bank easing cycle, plus such a high weightage, do you think that draws in global flows, or do valuations become a hindrance, and even passive flows will be hard to come? How does this unravel? Because to a normal mind, the normal mind would think that if the weightage is up, then at least the passive flows will be forced to come with the rate cuts.
No, so if we look at month by month FPI activity in various countries, one shall find that while in India, FPIs have sometimes come, sometimes gone, but versus other countries, we have got more consistent inflows. Now, FPIs as a basket, I mean, if you think of emerging market funds, as of now are a very difficult sell. I don't think the pool of money in emerging market funds is really expanding at a fast clip. So it is, reallocation of monies that are happening. So in Feb to, I think April, May kind of a period, Chinese market moved up 30% and monies moved there, and we saw outflows. After the Chinese market consolidated, moved down a bit, things again normalized for us. So is one thought. So if you look at consistency of flows over last 1 year, over last 2 years versus most emerging markets, India has received more consistent flows on a monthly basis. Now,
Interesting.
if our weightage moves up, so yes, when interest rates get cut and people find emerging market risk taking more competitive versus investing in their own markets, the flows will come in. And with that, monies will get allocated globally. And if our weight is higher, we should expect to see more money coming in. Now, other markets not performing well, it's not new. If you look at from 2000 till now, the only market which has proved in some manner competitive to US returns is India. Other emerging markets, frankly, have disappointed big time. So the thought today is whether we look at emerging market pack and we look at India as a part of it, or increasingly going forward, we are ultimately now fifth largest market by market cap, bigger by number of securities listed, and sooner than later, over next 1 to 2 years, we would probably be the third largest market. Can India become a asset class in its own right? Out of the emerging market basket. Ultimately, emerging market baskets got created because every emerging market then was small, and they needed a bigger pool of market cap, bigger pool of securities to entice global investors. Now we have become large enough in our own right. So I think the thing to watch for is, can we become an asset class by ourselves?
Okay. Okay. So, Prateek, I know it's usually difficult to time these things, and therefore I won't ask you to do that. But I just wonder if the nature of the winners, if the market were to move higher over the next 12 to 18 months, would change with the nature of the flows. Hitherto, DI flows, a lot of bottom-up ideas, banks not doing all that well, despite the weightage, etc. Does that change in the next 18 months because of the nature of the flows? If indeed the FI flows become maybe not as strong as the DI flows, but stronger relative to the past?
No, so let us look at reasons why FPIs come into an emerging market.
Sure.
It is for growth, right? Because if you are seeking value, if you want to buy cement as a business and see, how is the capacity priced, I think everywhere in the world, capacity may be priced lower than in India. So it is for growth. India as a country offers growth. Now, banks, large IT were the growth drivers last time when we got very strong FPI flows. This time around, they don't seem to be the growth leaders. Okay, the newer growth leaders is what we believe will attract the active flows. Passives, of course, will go as per the index weightages and so on. Now, in December of last year, we had one instance where yields dropped sharply in the West, and something happened to our market. Now, in the first month of that correction happening, it is the shorts which are getting cut. Okay, so these spaces which actually may not do very well over the next period do very well because it is driven by shorts getting cut. So in the month of December, you actually saw banks and IT do very well, the large IT. And after that, they have again continued to not do as well. So I think, if the yields abroad drop and there are rate cuts in the direction gets more known, yes, flows will be there, short covering will be there. That may cause a month and a half of change in the sectors which are doing well. But if the reason is really short covering, then I think the current spaces, which are the growth leaders, should continue to do well.
Okay. Prateek, how are you, as such a large AUM under your belt, now investing? Because you mentioned that FPIs come for growth. I'm guessing you are investing for growth as well. But if anybody who's investing in growth for the last 12 months in financials, for example, hasn't quite made money, right? So therefore, do you take a contra view and not be as high or be much lower than the benchmark weightage, let's say on banks? I'm not including the whole financials because AMCs, brokerages have done well. It is banks which are sulking, particularly private banks. How do you think of this as such a large AUM? How do you kind of navigate through this?
No, 1 hour AUM is not large, we are very small. So 1 lakh is the total AUM. On the mutual fund side, it may be just 50,000 crore. On the AIF PMS side, 27,000 crore, and the rest of it is passive. But yeah, that said, we are out and out growth investors. QGLP is the philosophy that we follow. We put a threshold that any space that we want to be in, and this is a team effort, should present on the space itself growth opportunities 2-3% higher than what the index will deliver over the next 3 to 5 years. And today, if you see our portfolios as a house, we would be seriously underweighted, practically not present in staples, practically not present in large cap IT, very little into banks. And this has been the position for last 1.5 years. We have gradually reduced it. The money is taken from there. So banks and IT is 50% of the index. Has gone to, yes, some mid and small cap IT names, but more to new tech, to spaces like renewables, spaces like electronic manufacturing, luxury consumption, etc., where the growth orientation is expected to be very high and in line with what we want to deliver to investors. So we are out and out growth investors. To our mind, we run some of the highest growth in earnings portfolios in the country. So yes, while we don't have banks, we do have some amount of insurance, we do have some amount of capital market presence in our portfolios. We have one more space that we have is defense. We continue to remain positive on these spaces.
Got it. The other, Prateek, is the need for new paper to come in as the market broadens and more flow sticks in. So we've seen the new age companies do really well, right? I mean, Zomato may be up 6% today on a JP Morgan note. But the thesis that, let's say JP Morgan is putting out for Zomato or some other houses have put in for some of the other stocks is alive and kicking. What's your sense of these new sectors getting created? We also now have an electric vehicle company listed, and there is more coming. So what's your sense of the new age sectors getting formed? Are you constructive here?
Very. So very constructive, very constructive. We may not own all of it, but we're very constructive. In fact, this is part of our thesis. We say this is time for alpha, and this is a theme that we have covered for last several months. Just like, if I give you a similar situation that happened in the past, just like software as a sector came into being in mid 90s and delivered huge alphas to managers over mid 90s to 2000 kind of a period. Look at the construct new space, not there in the index, large quantum of growth in earnings and 5 6 years of earnings growth on the trot. Delivered large alphas. In the similar manner, newer spaces like electric vehicle, electronic manufacturing, renewable, defense, new tech, etc., are doing the same over the last 3 to 4 years. And the runway of growth continues to be long and in many cases getting stronger. So we are very clued, very positive on newer age businesses.
Got it. Okay. Um, so very positive there, Prateek. The other thing is sectors that have done really well in the last couple of years and now are starting to take a bit of a breather. I mean, defense may be up in the last couple of days, but otherwise has now kind of cooled off from the frenzy that it was in. You guys have a defense fund as well, if I'm not wrong. What is the, I mean, how do you think about the story here when the common narrative is that yes, there is an order book, yes, there is execution, yes, there is indigenization, but the multiples are extremely stretched. So how do you think about it? Please explain.
So we have a passive offering on the defense side. Like I said, we are the largest passive strategy house in the country. We continue to be positive defense. I said that as a part of my earlier comment. To us, the current pause in the market is like a pit stop. Sometimes the narratives become very strong. Maybe valuations go a tad ahead of, or maybe let's say they rise so quickly that people get uncomfortable, and there can be a period of cool off. But really speaking, we believe this is a space where 15 to 20% growth on sales should be delivered, and with a higher growth in profits, and for a very long period of time. So we continue to remain pretty positive there. If you look at our active portfolios, practically all active portfolios, one should expect to find a defense name or two.
Okay. Okay. And Prateek, last couple of questions before we let you go. The other thing is, much like defense, is power, right? And power across the space. And I don't even think the finances may be expensive. But be that as it may, multiple ways to play ancillaries, hydro, thermal, green, what have you. And the sector has rallied, but the targets are very stiff. So is that also in line with the thesis that maybe there is a bit of a pause and the rally could continue? How do you look at power when you look at that very wide bucket?
Yeah, so let's say energy intensity of the economy stays the same. Actually, if we increase manufacturing as a part of GDP, energy intensity should be expected to increase. It shall increase also because, as per capita rise, people will opt for more air conditioning. And last summers, you saw air conditioners not being available at all. The shops were all emptied. So electricity consumption should be expected to grow stronger than usual into the future. Now, earlier there were other sources of energy, coal, oil, gas, etc. Now, as we become more green, a lot of this will get substituted by electric power. So, if we have, for example, all the two-wheelers and the cars increasingly electric, you need less of other fuels, you need more of electricity. So electricity demand would be higher on that count as well. Here, I think a good, nice way of playing is through new energy plays in solar and wind. There, the runway of growth is long, and I think valuations don't capture it all because the start was very skeptical. How long will it continue? Single use plants, what if it runs out? But the thing is, now there is no going back. Increasingly, if you look at FDRE bids, they're competitive, they're getting more and more competitive to thermal, which means future is all going to be renewables. So, or mostly going to be renewable. So I think that is one way of playing it. The second way is, of course, to look at stuff that goes into, suppose one is not sure whether coal does well or wind does well or solar does well. Get into stuff which goes everywhere, something like cables, etc. So it's the other thought that we have, control stations, etc. And that is what we have in our portfolio. But in these spaces, again, the longevity of growth is definitely there. Overall growth will be 7-8%, so that is significantly below the threshold we want. But in newer spaces, solar, wind, etc., even pump storage, growth can be an order different, and that is where our interest lies.
Got it. By the way, as we speak, the rupee has hit a record low of 83.99. Now, is this the storm before the calm? Usually it's the calm before the storm. But will we start to see the rupee strengthen at some point of time in the near future? Or do we continue to be weak? I mean, with crude falling, CAD improving, flows likely, rate cuts on the anvil. Prateek, a macro question to wrap up this conversation. A word on the rupee and what could happen ahead, and if there are investing implications on the same.
Yeah, so theoretically, with rising forex and everything that you spoke of happening, which is again positive for forex accretion, rupee should strengthen, meaning from close to 84, it should be closer to 83 or lower. But point is, forex is just one bit of the equation. Competitive intensity is another. If we look around us, and we compete with our neighbors in various goods, neighbors, such as Pakistan, Bangladesh, China, on various items. And, if their currencies are not strong, their currencies are weak, to some extent, it becomes difficult to retain, our levels with the dollar as well. I think that is what is happening, because otherwise our forex are at a high every week, every month. We keep accruing forex. We have gotten included in JPM bond indices, so those flows are happening. We may get included in Bloomberg bond indices. More flows will come, and so on. But I think it is this competitive thing which is keeping the rupee weaker than where one would believe it should be. Now, weaker rupee is good for corporate profits. IT get tailwinded. Every manufacturing which competes with imports, gets that much more protection, and so on. So, depreciating rupee is good for profits. What is good for profits is good for the direction of the market. In the past, when currency depreciated, markets fell because FPIs were a large part of our market activity, and in the thought of protecting dollar returns, you saw rupee weakening also coinciding with a lot of FPI selling. But now, since FPIs are a marginal part of the overall ecosystem, it is our money which reflects our fundamentals and markets. I think small rupee depreciation should be taken as a positive for market rather than negative, because it is positive profits.
Got it. Prateek Agrawal, always a pleasure talking to you. Thanks so much for taking the time out. You may be small in your eyes, but this is a great milestone. Wish you all the best for many more.
Thank you. Lovely to be here.
Yep. Lovely to have you.